Jimmy, how are you?
Jeremy, I'm great. Tax season is over. Back to the market insights.
That's right. We're in the second quarter here now, recording this April of 2024, and we're excited to kind of talk about what we've learned from the first quarter
Right.
and kind of what we see coming up.
Yeah.
So our portfolio points for this quarter, we're going to revisit the 2024 forecast, some of the assumptions that we had at the beginning of the year, kind of leaning into some of the experts' kind of ideas and
Right.
how are they playing out so far. So that's the first part. This next part is sort of fun. We're going to look beyond. There's a couple of different themes in there. We'll get into it. And then all politics. We'll be talking about U.S. politics and we'll be talking about geopolitics.
Fun times.
All right, this looks familiar, right? We did this last quarter. So you have 2% GDP. So we're kind of using the 2024 as our guiding post here. 2% GDP. All right. So how are we looking so far? So, well, in Q1, the GDP was 3%, but we're trending
down, right?
Lower, right? Because it was 3.4% the previous year, same quarter.
Yep.
All right, cool. 0% chance of recession. So I think this is probably still very much in play.
Yeah, definitely. We still don't have an answer on this yet, and I think soft landing is sort of the Goldilocks outcome, right? And I think that we were starting to think that was the most likely outcome, but maybe the deferred landing or no landing which I think would result in higher rates for longer, is now starting to be, increased probabilities.
Yeah, I feel like it's like there's a racetrack. The horses are coming around the bend.
We're jockeying a little bit, right?
Boy, oh boy, that deferred landing feels like it's pulling closer to the front of the line. All right, and then we got the inflation piece in here, and as we all know, this has been sticky. And that is the right terminology. Sticky is true. So CPI rose 0.4% in each of the first 3 months of quarter one.
Right.
So January, February, March, it kept giving us this staggered step up, and we're going to dive into that and talk about what's going on there. And is that concerning? It has been a little concerning to the market of late.
Right. No, so you think about the last 2 points here. These are the two mandates of the Federal Reserve, right?
Mm-hmm.
Price stability with inflation, and then the unemployment, right?
Exactly.
Like those are the two mandates that the Federal Reserve has. I don't envy them, right? Because it is such a difficult job to be balancing all of the underpinnings of those two mandates is quite a bit. And I think it's easy to sit back and play Monday morning quarterback and assessing the mistakes or the bright moves that they've made, but I don't envy the job that they have because there is so much involved in the inflation and then the unemployment as well.
Yeah, it's easy to be a pundit, hard to be sort of the internal, governor and president on these things.
Right.
Figure it all out is a tough thing. Data is imperfect, we know that, but increasingly, we've got some interesting stuff here. So we're going to start with unemployment. We're going to get in the next slide here.
Perfect.
All right, so where I want our attention to go is going to be in the upper right-hand side, the labor force growth, native and immigrant contribution. I think this was really interesting. Recently had an opportunity to go to JP Morgan's Wealth Symposium in New York City, and Dr. David Kelly was talking specifically about this. He said, look, it's kind of a weird scenario that we've got in the U.S. right now because we are seeing the wages go down a little bit, but you're also seeing the growth in employment at the same time. And that growth in employment has been pretty consistent and pretty strong. What's underneath the hood here? So it turns out that foreign-born individuals are driving a lot of that delta, that growth.
Right.
And so he talked about, and look, you can get into a big political debate around immigration real fast.
I was just going to say, you want to have the illegal versus legal immigration debate?
Exactly. But the reality is there are immigrants coming to this country. Some of them are coming under the asylum laws.
Right.
And so there's a backup in the asylum courts, and they get an opportunity after 6 months to go out into the economy and participate.
Right.
And so with a 5-year backlog on that, that means somebody can legally be here working and participating, and it seems as though increasingly that is happening. Right. Those are filling those jobs, filling those job gaps. Right. At the same time, bringing the cost of the wages down and keeping employment strong.
Well, I think again the whole legality around immigration that can be debated by somebody else, but I think there's no question that we have needed more workers here in the U.S. for quite some time.
Yes. So the Fed looks at this stuff very incisively and says, okay, you know what? I think they're looking at, and they're kind of checking the box, like labor market strong and full employment strong.
Right.
Looks like it will continue to be so.
No question.
Then there's the other side of the coin, inflation.
Sticky, right?
For sure. So that 0.4% per month, each of the first 3 months of the year, has people a little worried, right? And it's changed the game a little bit for how people are reacting to inflation now.
Right.
Because I think we thought, stick a stake in it, we had won the game in December, but it's proving to be harder to drag it down in that last mile.
Right. Well, if we were to just take like a step back and think about this from a very high level perspective, in theory, the Federal Reserve uses monetary policy to help move inflation as they need be to achieve their mandate. In theory, when you have high inflation, you want to increase interest rates, suppress the money supply, reduce demand, cool down the prices, right?
Right.
And I think we were just in this world this ZERP world, right? The zero interest rate policy for such a prolonged period of time. I think, part of me thinks that, man, the market was just yearning for hearing about cuts again.
Yeah.
I mean, right?
Yes.
We've been used to zero for so long, and we haven't gotten a cut in a while here. And as a matter of fact, we've gotten a bunch of increases over the last year and a half. So, again, it's to the stickiness point that you made earlier. I think the term is perfect. It's just proving to finish the job of the Federal Reserve's target of 2% inflation. Proving to be pretty difficult.
It is. So what is it that's driving maybe some of the increases, and what's proving really hard for the Fed to slay? It turns out shelter's nothing new. You can see going back to 2021, shelter was an increasing portion of the inflation picture.
Right.
And it's come down. But what's kind of then come in its place is motor vehicle insurance. So you have these two things, shelter and insurance. Tell me how the Fed's going to attack those things. They don't really have the tools.
Well, that was my point before. But saying, I don't envy their job. There's so many variables underneath the hood of what they're trying to do. No pun intended with the motor vehicle insurance and being on the hood, but it is. There's just so much that they're trying to. That's why when you talk about monetary policy, it's not like a precise instrument, right? It's very much a they're not. It's more of a shotgun approach, right?
Yes.
This is not a sniper rifle that we're using to attack this.
Agreed. So here we are, right? Those things are persistent. Those things are problematic. Fed really doesn't have the ammunition to deal with it. Okay. So Fed and the interest rates. We've looked at this slide before, and it's something we'll continue to look at. Goes all the way back to 93, but here, look at where we're at. Current mode. I guess it's 5.38% where we're probably counting ourselves right now.
Yep.
And then on the dots, falling down into the future of the line chart, where we may go.
Right.
This sort of dot plot consideration has been proven to be very, very inaccurate.
Well, I was just going to say, if you think about if we were to work our way back into 23 or 22, whatever the last time we have used this slide in the market insights, you're going to see the similar thing where we flatten out at that 5.38 and we see that line going flat across. The expectation was going to roll over very quickly. The Fed expectations, the market expectations, everybody was rolling over quicker than what has been the case. So, when we start to look back at these 2024 prognostications, and anybody who are the quote unquote experts in forecasting, it's a very difficult task.
Yeah, it sure. I mean, we've said this one before. The Hall of Fame for prognosticators and predictors
Yeah,
of the Fed is empty.
empty.
Okay, so nobody's winning here. But what we're seeing though is okay, there's still the anticipation that there's going to be cuts in the future, right? The Fed wants to bring the actual rate down. That's kind of their mission right
Right.
now. But they're continuously saying we're pumping the brakes, and we're gonna wait and see what the data says because this inflation is a problem, and we don't want to cut too fast too soon.
Sure.
So what was at one point 5 or 6 cuts this year anticipated now is increasingly being considered to be somewhere in the ballpark of 0 to 2.
Right. Yeah. So I think that now we need to start shifting that into like, so what does this mean from a portfolio construction perspective?
Yes.
Right. Like, what does this mean for your portfolio?
Well, and that's a great segue because now we're going to talk about fixed income. Okay, so the fixed income is a great jumping off point for okay, what has this direct, correlated impact from the Fed rates to fixed income? It is strong,
Very strong. Right.
and we're going to see how that strength plays out in present day and in other modalities for the future.
Sure. I love this slide. This has always been one of my favorite fixed income market dynamics. I would take a step back here and say, at a high level, I think a lot of investors are aware that when interest rates go up, the price of the bonds that they own would go down, and vice versa, right? So we understand that there's this inverse relationship between the price of the bond and the interest rates, the market interest rates. And so what we're seeing on the right side of the graph here is the impact of a 1% rise or fall in rates. And what you're going to see is, the blue line represents a 1% fall. So you're going to see these are positive impacts on the price of the bond because it's a 1% decline in interest rates. A 1% increase measured in the gray bars is going to show the opposite. And when you look at things that are longer duration bonds, like the 30-year U.S. Treasury, sort of in the middle of the cluster there, the most volatile, right? Yeah. The widest potential opportunity for gain there, but also the largest opportunity for loss.
Yes.
The longer the time that you own the bond, the more sensitive it is to interest rate risk. What I find interesting in thinking that is that this was the year that we had been talking about and hearing about. It's probably time to add some duration to your fixed income portfolio.
Absolutely.
Right? The short end of the curve has been a good place to live for 22 and 23 as the Federal Reserve is increasing the short-term rates. The yield curve is inverted. We're able to benefit from the shorter term higher interest rates. Maybe it hasn't played out as well as what a lot of those prognosticators thought, but just to point out on this slide, one of the other things that's important about fixed income, where this broke down in 2022, is the correlation to the U.S. stock market, and so it's like, why do I even own bonds in my portfolio?
Yeah. Right.
And it's not. It can be different reasons for different folks. It can be income production. It can be capital preservation, whatever the reason for owning bonds, but a lot of times it's you want to have that negative correlation to the stocks, so that not everything is zigging and zagging together, and so that's where you see that the red numbers in the right hand column of the chart on the left. You're still seeing some negative correlation, but the concern that you have here is that these numbers stay a little bit higher and closer to 1 than we would have liked, because that's what we saw in 2022 was every correlations went to 1, and even as stock prices fell and interest rates are rising, the bond prices got beat up as well.
It's been vexing, to put it mildly, because right. If you were to be a student of the bond market, the bond market was giving you a lot of symbols and signals that it was going to change. It was going to react, and that the Fed was going to have the capacity to drop rates, and the bond market was going to be the beneficiary of that.
Absolutely.
It really hasn't been. So with that, we're going to take a look at how are we doing year to date on bonds.
Okay.
So you got 3 different lines. Again, this goes back to the beginning of the year, so not a huge sample size here, right? We're talking about 3.5 months or so. You've got the Bloomberg Global Aggregate, all the different bonds kind of collapsed into one.
Yep.
You got a Vanguard short-term corporate bond, and then you got the iShares 5 to 10 year. That's an intermediate bond fund. Okay. Look, aggregates down 4 and 4.29, 2.25 for the intermediate, and even on the short term, you're slightly down.
Right. So again, this is the opposite of what was expected thus far. This is where those prognosticators, seem to have gotten another one wrong for the time being.
Yeah.
Right.
Yeah.
This is time to add the duration and extend the duration in your fixed income portfolio, and it's just been a tough place to be, and you have to remain patient.
You do.
But thus far, again, to your point, short period of time, just over a quarter of a year.
Yep.
But not super exciting returns there.
It's been frustrating, I think, for people because the expectation is that I'm going to be able to put money in and I'm going to be able to yield what the yield gives you. But again, because the bond valuations have changed, and you're getting these returns, these total returns that are significantly lower than what your coupon would provide. Right.
Yeah.
So it's a headwind, but it'll change. It's just a matter of time.
Right.
So the yield curve tells us a lot, and then it doesn't tell us anything all at the same time. It's a funny thing, right? Because the yield curve has been for 2 years inverted.
Right.
And that would signal to us recession on the horizon.
Yeah.
But yet, what have we done? We've skipped the recession.
Right. Thus far, at least, right?
Thus far.
Yeah. I just think it's crazy to me. When you look at the gray line on the lower part of this chart here with January 1, 2022, and to see what the yield curve looked like there, that is a very normal looking distribution.
Yeah.
And then you compare it to where we're at the end of March and where we were at in the beginning of 2023, significantly different.
Yeah, and I mean, look, even that difference over the course of a year and a quarter, right? 5 quarters of time, it's still it's a pretty, again, at the short end of that yield curve, it's still pretty strongly divergent.
No question.
There's no doubt about it. So, look, what's the advice here that you're giving to clients? I think that, I was probably more in the camp of, hey, let's add duration. But now I'm kind of swinging back to the place of let's just stay at the short end of the curve. Let's stick there for the most part.
Right.
I do believe there's going to be a payday for those who add duration to their bond portfolios.
No question.
There's no doubt about it. But for those who are impatient like me, let's just stick around the short end of the curve.
So we all have these inherent biases, right? So even you fall victim to them?
Oh yeah. Oh yeah.
No, I agree. Listen, there's still a reason to hold fixed income in your portfolio. It's just a matter of understanding what you own and why do you own it, and it's been a difficult little shorter period of time here for the bonds.
Yep. All right. So this is our transition slide. We're going to talk about these beyond themes. So let's get into it. Beyond the Mag 7, that's the Magnificent 7. For those of you who have been kind of consuming our videos, our 2 fiduciary videos, we've talked about this a little bit. The Magnificent 7 are these 7 companies that are listed in this slide here. And they drove a lot of the growth that we've seen throughout 2023.
Yeah, I mean, I think you can go back further with a lot of them, right? Because we've had the different iterations of there was the FANG stock, there was the FAN Mag, it was now it's the Magnificent 7. My goodness, what a year for some, and really in a bad way for others.
So this is a year-to-date look at them, and clearly Nvidia is kicking butt. They have been. Meta's been doing great. Amazon, you can't complain there. Then it starts to kind of settle in. Microsoft has had a good year, but nothing, not a rocket ship.
Right.
Look, Alphabet has actually come on lately.
Yeah.
And they've done really well too. The guys who have had a tough year, Apple and really Tesla.
Right.
Right. So we just want to point that out that this is changing. This is a picture that's very dynamic.
Right.
And things are changing. When you look at the brownish line there, the Spider S&P 500 ETF, it's kind of in the middle,
right,
at 4.5%, and then that's about what you would expect. That's the total, all 500 companies of the S&P 500.
So my takeaway then is I should be enthusiastic in the overall performance of the market, given the impact, the size of Apple and Tesla before the year started, and the relatively poor performance. That I still have a positive return in a broad-based benchmark is, it's pretty encouraging.
Absolutely, and I think that it tells me too that people who said this market was all about Apple, this market was all about at one point Tesla, so on and so forth. Okay.
Yeah.
True to an extent, but really not durably true.
For sure.
Right. So I think that's the important thing. And this slide shows that in pure percentages. So in 2023, within the S&P 500, that Mag 7 was producing 60% of the contribution. Let's go to March of 2024 on the far side here. It's only 34% now.
Right. Big change.
Big change. I mean, it's a flip flop.
Completely.
So you have a broadening of the market. You have more companies that are getting some love from investors.
Right.
And perhaps people are trimming some of the gains that they've seen in this magnificent seven.
Which I think are very healthy market machinations, right? Like you've got people that are now, instead of just pounding all their money into the Mag 7, they're doing more research to identify other good opportunities out there. There are a lot of other really good companies out there that are making good products, services, strong balance sheets, positive cash flow, things that investors want, but maybe just got blinded a little bit of like a FOMO, of the fear of missing out on some of the gaudy returns to the bigger ones. And now we're seeing that broadening, which is again healthy market behavior, that the market is able to then still produce you a positive return, even though some of your largest shareholders are down quite a bit year to date.
I'm with you. To me, it tells me that there's other companies to invest in they're highly investable.
Right.
And that these Mag 7, I don't think anybody is sitting here and predicting their imminent demise. That is not the case. It's just a changing of the guard for a bit here. These Mag 7 are still great stocks. They're still very investable themselves, right? It's just a broadening of the market, and it's, to your point, I think health is the right term.
Yeah.
It shows healthiness. Beyond borders. This is kind of fun. So increasingly, from a philosophic point of view, we have been saying to ourselves, look, does it really matter where the good companies lie? Does it matter that they're U.S. companies? Does it matter whether they're European companies,
right,
Japanese, you name it?
Right.
And I think increasingly the answer is absolutely not. This is a global post-industrialized world where everything is highly interconnected in a free capital market. So let's go after the best companies no matter what.
Right. Totally agree with that.
So this actually shows a little bit of that. Of course, there are a variety of ways to invest in the best companies in the world. One of them is through this ETF called the Capital Group's Global Growth Equity Fund. It's CGGO. It's returned just under 6% for the year.
Mm-hmm.
Compare that to the S&P 500, which is 4.5%. It's outperforming.
Right.
So these are both like sort of in the same category, large cap growth style ETFs.
Right. I think, and when you look at the bottom two lines you have here, the light blue and the light green representing the indexes for developed international markets and emerging markets, you think about how benchmarks are built, and I think this sort of beckons the debate of sort of active stock picking versus passive.
Right.
And in what markets and in what time periods. It's not to say that we have a belief in only one or only the other, right? I think that different strategies have their time to be leaned into, and others not so much. But the idea that there are not good companies to invest in overseas is foolish. The idea that you can't find really good companies making steady free cash flow streams over there is, whether that be developed international markets or emerging markets, is silly. So you want to find a manager who can help you sort of siphon through the ones that you don't want to own over there, and also the ones that you don't want to own here domestically.
Yes.
Right. And if you can do that, and I think theoretically it makes sense that you can identify these companies, you would have superior investment returns.
Correct. I mean, at the end of the day, where a company is domiciled doesn't even necessarily give you any indicator where their market share is,
Right, for
right?
sure.
You could have a European company who is primarily uh, building most of their revenues out of the U.S. market,
For
and
sure.
that absolutely happens,
Yep.
right? So that's just a good example of how this plays out and the way we want people to think about this from a philosophical perspective, right?
Right.
Is see the world without these borders, and it opens up your eyes and the opportunities.
Absolutely.
All right, so the next theory here, or theme, I should say, is beyond cloud. So this is a lot about the AI movement that
Mm-hmm.
is storming really all of these businesses, the entire capital market, and it's invading all of culture, and we're just talking about it a lot. So what does this mean for, investors?
Right. Yeah. I think this is one of those things that, we really saw it surge last year, right? I mean, in the middle of the year, that's when we saw like the AI boom sort of go crazy, and the stock market followed it with the companies that, appear to be benefiting the most from AI at this point in time. One of the things I would just take a step back and say, I think this is really important to understand that the companies that are doing great with it right now might not be the companies that continue to do great with it. And there might be some others that haven't sort of shown themselves to be, identifying, useful applications of the technology. And so it's just one of these, like, we got to just sit back and wait and see how things unfold.
Right. I mean, you could take this concept of beyond the cloud in two different ways. It could be cloud computing that we're thinking we're moving beyond that iteration of innovation.
Right.
You could also say beyond cloud, as in like once the cloud clears and the skies brighten up a little bit more, we can kind of see who and how AI is going to play out.
Right.
And I think there's a bit of that fog in the air right now. We just don't know.
Yes.
But it's interesting to kind of dive into this a little bit and see what does this look like. Capital Group has come out with this. We thought it was interesting. From top to bottom, it's like where is the greatest level of investability today? It's in the computing space, the chip providers. This is part of the reason why NVIDIA has done very well.
Yep.
Infrastructure, you have data centers. This is really interesting. When I was at that JP Morgan conference, they were talking about the amount of data center growth that we need in order to support AI is exponential. So data centers are, they're the huge computing hubs in a modern day ecosystem, and they are huge energy consumers. The extension of this was like, hey, look, energy needs are going to increase, not decrease.
Right.
So, maybe don't forget about those fossil fuel companies right now either, because they're going to play a part in the AI's ability to grow.
Oh, yeah.
So
Absolutely.
it's really interesting when you kind of think about that interconnectivity.
Right.
Models, applications, beneficiaries. They didn't mention energy. I wanted to bring that up because I think it's a missing point in this particular slide. But they're also saying, hey, look, healthcare, financial services, many others.
Yeah,
right?
Absolutely.
And again, not that we are, we're independent advisors, but JP Morgan, having recently been to the conference, it was interesting to hear what JP Morgan is spending on their technology budget.
It's incredible.
It's $15 billion a year, and they literally have 2,000 people who exclusively work on AI initiatives. 2,000 people every single day.
That doesn't tell you what they think is important.
Exactly. So that's a bank, that's a financial institution. They're looking to take that data and really, really understand it, and they're looking to turn it into gold.
Right. No question.
And lastly, this is what you were saying before.
Right.
We do not know how this is going to change, which companies are going to be the next innovators, the next stars of the capital markets, because this stuff changes. You look back in 1980, it was IBM at the top of the heap.
Right.
Oh, by the way, 1990, they were still there. Where the heck is IBM now?
They're not. They're not there. It's crazy, right? But it's true, and I'm sure if you were to ask you or me or anybody who was working at this time in the 80s or 90s, where do you think IBM's going to be in the next 20 years? Of course they're going to still be the largest. They're going to be the best.
Yeah.
And then they're not even on the page here.
Right.
So again, we love these magnificent 7 companies. They've been great disruptors, leaders, innovators. They just might not be the same companies that carry us into the next decade.
Right. Investors have to be agile.
Right.
If they're not agile, they're going to be probably left behind.
I would agree with
And that's the cause. As investors, we just remember you got to be agile. Okay.
Here we go.
There we go. Politics, right? This is everybody's favorite subject. So we've got domestic politics, international politics. We'll just kind of take a few slides and take a look at this. Uh-oh. U.S. politics, right?
Lloyd and Harry?
Lloyd and Harry. I don't know. That's the Dumb and Dumber movie, right?
It's hilarious.
It was a good movie. A good movie. And, listen, our job as financial planners is not to get into the thick of politics, but is there some craziness that goes on? For sure.
Right.
Right? Do we have a lack of compromise in Congress? Yes, we do. Do we have some bad behaviors and some inability to legislate? We think so.
Yeah.
So that's why we put this up there in fun and in jest with a little bit twinge of seriousness, right?
Yes.
But at the end of the day, what we don't want people to do is get caught up in the storm of politics.
And we've clearly seen it both ways, right? I mean, it doesn't matter. It's
absolutely.
There are some that are really upset. There are some that would be really upset by whatever the result of the election is this year. There are some that would be very happy with it. Mm-hmm. It's just really important that you don't allow those beliefs to spill over into your financial plan and the investment allocation.
Precisely. So we've done a lot of versions of looking at how do the, say, presidential politics play out and how do they have an impact on the markets and you as an investor. And we thought this one was really interesting because it's so deep. It goes all the way back to 1900. And just imagine if you had taken $10,000 and invested in the Dow back then, you remain fully invested.
Right.
That's that top purple line that keeps climbing higher.
Right.
But let's then imagine if you only kept that money invested during a Republican administration or during a Democratic administration. You got to go way down that list.
Not very good,
them, right? You're not going to participate.
It jumps off the pages here, mm-hmm. right? Like staying invested. These are, things are going to go your way, things are going to go against you from a political perspective, and just don't allow it to harm your portfolio.
Spot on. And then there's geopolitics. This is that international side, which just seems to be an increasingly, depressing place. We have Ukraine and we have what's going on in the Middle East and Israel and, all the strife going on there. We've got China, which seems to be a tinderbox of all sorts of different mm-hmm. issues. But look, if you go back in time, there have always been a lot of issues. And that's what this chart, with all its craziness, attempts to show you is that there has always been a lot of geopolitics.
Right.
Events that could and did and would have an impact on the markets. But they were very short-lived.
Right.
And they don't sustain themselves. There's not a durability to them like you would think.
And I think you can certainly make the argument that it's even a quicker bounce back today than what it was. We're going back quite a ways here, but I think your bounce backs are happening even quicker today.
Right.
Like, yes, the news breaks. Look at what the futures market does, and then it might, it's 2-3 days later, and you're back to trading, higher than what we were before whatever the event was.
Right.
And they're always going to exist. There's never going to be this pure, green light across the board for you to just go ahead and invest and everything is good. Inflation's great. Employment is strong. Geopolitics are sound everywhere. It's never going to happen.
No, you can't wait for that perfect moment, that wedge moment where it's like, the world is a beautiful place.
Yeah.
And it's all sunshine and butterflies.
It's not going to happen.
It doesn't give it to you.
But waiting to try to time that is just you're gonna be on the sideline for some really good events if you're sitting there trying to time it.
So true. You know, I heard in a podcast recently, and this goes back to, I guess, when was it? I'm gonna date myself here, but John F. Kennedy was assassinated in, was it 1962? I think. So the Monday after he was assassinated, the Dow Jones went up 5%. Okay. Would you have thought that?
No way.
I mean, the U.S. president
Right.
was assassinated,
Right.
and the markets go up. Okay. That just goes to show, and this is something we've talked about a lot, is that in the short term, you don't know what markets are going to do.
No doubt.
Right? I mean, they can go up, they can go down, they can go sideways. The long-term bias is for, an upward trend over years.
Correct.
And decades.
Yep.
Which, all this speaks to market timing. So we just wanted to give this a little bit of a nod and understand this, because I think one of the things you struggle with is when you've been having a bull market like we have since October, call it November of 23.
Mm-hmm.
You have fresh money coming in, you have a liquidity event, and you're like, boy, what should I do with this money, right? Should I invest it now?
Right.
Should I hold on to it, stay in cash? What should I do, right?
Tough.
These are tough questions to answer.
Yes.
So we attempt to look at them from a data-driven perspective. Investing at all-time highs. This is the S&P 500, right?
Right. Yep. So I think it's easiest to see on the right-hand side of the chart here, but looking out, 3 months, 6 months, 1 year, 2 years, 3 years, comparing investing any day compared to investing at a new high. And I just think it's fascinating. Like, look, the trend is upward across all those time frames, right? But you're actually, when you got the longest time frame here, which is 3 years, the best return is actually when you're investing at a high. I think most folks understand momentum.
Yeah.
Objects in motion have a tendency to stay in motion, right? And stocks are in that, in a similar light there. That stocks that have been going up tend to continue going up. So.
I think that's got to be the truth behind it, because this doesn't match up with the logical meter to me.
Right.
Right.
Yeah.
But I know the data is good.
Right.
I know the data is solid.
Yeah.
I am, like so many other people, and I'm sitting here and saying, oh, what about buying the dip?
Right.
I want to buy cheaper, not higher. It turns out it doesn't matter.
Right.
Or maybe it does. Maybe it does matter, and in fact, you should just be buying at the higher points. It's a crazy concept.
It is, no question.
But I think it's so important to understand that what it does is actually it allows you to hit the easy button and say to yourself, just take the leap.
Yep.
Right. Just get into it. Do your allocation that you're going to do that's appropriate for you. That doesn't mean all their money into the stock market all at once, because that's what you should be doing. No, that's not right for every individual.
No question.
In fact, you have to figure that out through a financial plan. But
we're gonna say that at some point today, right?
Yeah,
like we always interject here the importance of a financial plan on the investment decisions.
Exactly. So, but the easy button can be hit once you're ready.
Correct.
With your financial plan, execute. Go ahead and execute.
That's right.
Just go forward. Move forward. So how does it look for the bond market? That's interesting too, because the last one was the S&P 500.
Yep.
And the bond market is a similar concept. The idea here is, if you've got money in cash and you're thinking about getting into the bond market, how should you do that? Should you get into that through a lump sum, put it all in at once? Or should you dollar cost average or over a period of time, kind of play it out over a, period of time? And it turns out it doesn't really matter that much again.
Right.
If anything, I want to look at the differentials between the teal line and the darker green line. There's a slight kind of bias towards the lump sum.
This comes back to bonds are boring.
I know. You got to get your coffee here, man.
Right.
So there's slight bias towards the lump sum, I guess, but it doesn't tell you a whole lot, right?
Right.
It's really, I think the story here is when you're talking about the historical probability of outperformance in all periods,
Right.
it is what it is, right?
Yeah.
Okay. But we know that we're in a time right now where there's an inverted yield curve, and that's significant in the bond market.
For sure.
So how does that change things? Ever so slightly. Ever so slightly. And on the 6 month, maybe you do the dollar cost averaging, and but then on the 24 month, it's a little, it changes things ever so slightly. But what I'm telling you guys is, do we really think people are going to have a different policy for this ultimately?
Right.
No, we don't. We want people to do what's comfortable for them. I think that's the message that I would say when it comes to getting back into the bond market, right? If you feel comfortable putting $100 a week into the bond market, chances are it's going to work out for you.
Right.
If instead you want to put $500 in at a time and that's your lump sum, knock your socks off.
Right. Yeah. It's again, it's one of these things that I've seen it go both ways with clients that have big lump sum moments in their life that they want to put it all in, or they want a dollar cost average in, and it's just, when you have a plan built, though, it's so much easier to get you to take that step to put that money to work.
Yep.
But again, timing it is just so difficult. This idea that you're going to know best when to put it in or when not is so difficult.
It's a good point. So really just, it goes back to staying invested.
Right. The allocation that you develop in your plan, right?
Yep. Cash is king, yes, but it's usually better someplace else for the long run, especially when you're talking about a sticky inflation environment. Okay, asset allocation. We always come back to this. So this is the bread and butter of what we do, is we get people allocated into a variety of investable opportunities that are right for them.
Yeah, you got to figure out the asset classes, right?
Absolutely. So we've talked about this a lot, and we will continue to talk about this a lot, because this is sort of like, this is our periodic table of returns.
That's right.
And we look at this, and we really study this. So it's banded. The white section there is the asset allocation. That's the 60-40 model.
Right. Yep.
Right for a lot of people, not right for everybody.
For sure. What do we say? Like, being diversified means always having to say you're sorry, because you're never going to be at the top with everything, but you're never going to be at the bottom as well.
Yep.
Right. And so it's just one of those things that's like a mathematical phenomenon, but being in the asset allocation has provided really good, above average annual returns with below average annual volatility.
Mm-hmm.
And when you're trying to make sure you're getting properly compensated for the amount of risk that you take in your portfolio, having good having above average returns with below average volatility is a step in the right direction.
Great. Here's another way of looking at asset allocations. I think it's kind of a fun way to look at this. This goes years to date, and we're talking about an all equity benchmark at the top,
Mm-hmm.
and then you go down from there, 80% in equities, 20% bonds, 60-40, 40-60, 20-80, and then all the way at the very bottom actually is all bonds. What is it telling you?
I mean, it's a relatively tight year to date.
Mm-hmm.
We're only a quarter of the way in, but you've got a 7% dispersion between the best and the worst. It's relatively speaking not that high. Now, if that persists over the course of the entire year and you keep going at the same pace, then that number is going to look much larger. Yep. But look, what it tells me right now is the risk on trade has been the place to be.
Yep.
The equities and the stocks across the board have outperformed the fixed income counterparts, and as long as interest rates aren't going down, it's going to be tough for fixed income to outpace anytime soon. But again, this is a snapshot in time.
It is
important to look at this stuff over long periods, short periods of time, so you can identify momentum and trend, but also keeping proper context with zooming out for longer time horizons.
I appreciate your contextual answer in that space. I think it's the most important thing. But it does say, and it's not surprising that equities are going to typically outperform.
Yep.
I think again, what is sort of surprising to me, but it's all a function of what we talked about when we talked about, the Fed and the bond market, is that, your yields out there are pretty high, and yet your bonds are still underperforming
Right.
in a significant fashion, right? I mean, in the sense that they are, an all bond index is negative 3%. So again, just know what you're getting into, know how that plays out. Um, Nothing more to say.
Yeah. You got to make a plan though, right?
Well, you jumped the gun.
There
Yeah.
we go.
Let's make a plan. So we wanted to just show the CFP logo here because proudly both Jimmy and I are certified financial planners. Well, we've put the time and the effort into maintaining that earning and maintaining that credential. And so we just want people to know, like, this is a good starting spot for you, because at the end of the day, you need to have a financial plan in order to make good decisions. If
Right.
you don't have a financial plan, you're probably already behind the 8 ball.
Right.
And making these decisions in space is going to be untethered. And if you have that financial plan, you are in fact tethered, not in a bad way, in a good way, to something that is consistent and that gives you guidance and a compass.
Not everybody in the world is meant to be a client of On Track.
Right.
And we're not meant to work with every single person in the world. But the advice I think that you and I both give to anybody who is starting the process of considering hiring, a financial planner is, starting point number one for you should be identifying a CFP, right? I mean, this is, to your point, the time and effort that we put into to achieve and to maintain the credential. It's a lot of time, a lot of study, a lot of effort, and it's something that we're very proud of. And it doesn't have quite the recognition of some of the other certification like a CPA. It hasn't been around as long, but it's been around for quite some time, and I think they're starting to do a good job marketing.
Yep.
You're starting to see some more TV commercials with the CFP, but again, this is really important. Have a plan. If you don't have a plan, you're gonna feel potentially lost at any moment in time with your investments. So it's something that we've obviously been pounding the table for a long time, and we're very passionate and proud to be CFPs.
Well said. If you guys need to get a hold of us, here's our contact information. But it's been a pleasure.
Yeah,
Q2.
Jeremy, thank you. I appreciate it.
These are the Q2 insights. We will be back again for the Q3 insights in another 3 months. And until then, have a good one.